In today's video, we will try to discuss about one of the most debatable issue of recent times, that is, should one invest in passive mutual funds, also known as index funds, or should continue with active mutual funds only. So let's first try to briefly understand what is the difference between both this type of funds, and in the later part of the video, we will try to understand the advantages and disadvantages of these both types of funds and understand when and how and who should invest in active or passive mutual funds. We will also compare the returns of active versus passive mutual funds across different equity categories, that is large, mid and small cap funds using real data. Hello everyone, I am Dhaval and welcome to my channel DIY Finance. So to start with, mutual funds can be categorized based on how the portfolio is managed. The two types are active and passive, also popularly known as index mutual fund schemes. First, active mutual funds or actively managed mutual funds are those wherein the fund manager continuously keeps looking for ways to generate better returns. The fund manager sells and buys stocks whenever he sees an opportunity. The index fund or passive mutual funds are passively managed mutual funds wherein the fund manager does not actively manage the portfolio. The portfolio reflects a specific index, that is, the money is allocated in the exact same way as it is done in the underlying index. Any change in the portfolio is done only when there is a change in the index composition. Index funds can be broadly categorized in following types. First, broad market index funds. Second, market cap based index funds. Third, equal weight index funds. Fourth, sector based index funds. And fifth one, international index funds. There are also other type of index funds also. But in today's video, we'll discuss about market capitalized based index funds, that is large, mid and small cap index funds only. For comparison between active versus index funds, we will be considering only the past returns, as index funds mimic the underlying index. So comparison of other risk parameters like alpha, beta or volatility does not make sense, as the index fund would have almost the same risk parameter values as that of the index. Firstly, let's compare the large cap index fund. This fund would replicate the Sensex or Nifty and can be compared with actively managed blue chips or large cap funds. Here I have taken data of two index funds. First one is the HDFC index fund, Sensex plan, which replicates the BSE Sensex, and second one is HDFC index plan, Nifty 50 plan, which replicates the Nifty 50. For active fund, I have selected two funds, that is Axis Blue Chip Fund and Canara Robeco Blue Chip Fund. I have selected this fund as they have been rated 5-star by quite a few independent websites and also are quite popular in its category. You can select any active fund of your choice for this comparison. The results may vary a little only. On checking the returns for period above 1 year, both the actively managed funds, that is Axis and Canara Robeco Blue Chip Fund, easily beats the index fund with a good margin. But if we look at the returns for 1 year period and lesser, these funds are not able to beat the returns of index fund. We will firstly compare returns across all the three categories and then try to analyze the pros and cons and decide which type of fund to choose. Now let's compare the midcap index fund. This fund would replicate the Nifty Midcap 150 index and can be compared with actively managed midcap funds, which also have Nifty Midcap 150 as its benchmark index. None of the midcap index funds are more than 3 years old, hence we would only be comparing the returns of 1 year and less only. On checking the returns, it is very clear that the index funds are not able to beat the actively managed midcap funds. Now let's compare the small cap index funds. This fund would replicate the Nifty Small Cap 250 index and can be compared with actively managed small cap funds, which also have Nifty Small Cap 250 as its benchmark index. None of the small cap index funds are more than 3 years old, hence we would only be comparing the returns of 1 year and less only. On checking the returns, it is very clear that the active funds outperforms the index funds with a good margin. So before coming to the conclusion, let's quickly see the pros and cons of both this type of funds. First, index funds. The advantages are low expense ratio, typically 0.1%. Second one, as the fund manager does not have liberty to select stock of his choice, there is no human bias in the process and has to follow the stocks in the index only. The third one, as there is no issue of underperformance of the fund, people generally follow a buy and hold strategy which results in lesser capital gains. Now let's look at the disadvantages of index funds. As the fund does not have liberty to choose stocks, the selection of stock is limited to index stocks only and lead to fewer options. Second one, the fund is never able to outperform the index, so better returns or alpha is not being generated. Now let's look at the advantages of active funds. The fund manager has the flexibility to choose the stocks. Second one, due to the option available for choosing the stock, the fund manager can generate returns better than the index and the category. Now let's also look at the disadvantages of active funds. The expense ratio of active funds is more than that of the index funds, which can impact the overall returns. The fund manager, to generate better returns, can pick up riskier stocks, which in turn increases the overall risk of the fund. Before coming to the conclusion, who should invest and which category to invest, I would request all of you that if you find this video useful, please give a big thumbs up and also share this video with your friends. Also subscribe to my channel if you are not done till now. It's absolutely free. Your likes and shares would provide a big motivation to make more videos like this and help the channel to grow. So now coming to the conclusion, who should invest and which category to invest. Firstly, from the above comparison, it is very clear that large cap index funds are able to beat the active counterparts, and I feel that this trend would continue in future also. So one should consider large cap index funds as a part of the core portfolio. For mid and small cap index funds, I feel that still the time has not come to switch to them or make a part of the main portfolio, as they are unable to beat the actively managed funds across time period and also are quite new in the market. Surely, we should keep a watch on its performance and see whether they are able to beat the active funds in future. This is also evident from the attached graph. I also feel that long-term investors, especially the ones who are not able to track the active funds regularly or just want to invest and forget for 8 to 10 years, can invest in index funds. Do check my older videos. Links are attached in the cards. Thank you.